Hello, once again, everybody. This is Kevin Shortell returning with part 4 of this ongoing series of how the pandemic is affecting the real estate note, and of course the lending business. This video focuses specifically on loan applications and non-qualified loans. I've been talking about non-qualified loans for over a year, showing how the non-banks were starting to write loans that looked very, very similar to what happened in the lead up of the last crash in 2006 through 2008. Low down payment, no down payment, low interest rate, etc. And of course, they were the first ones to go bad when the market changed. Well, obviously, we're in a huge market change right now. So let's first start by looking at the Mortgage Bankers Association Purchase Mortgage Index. So in this index, what we've seen since the beginning of the year, starting in January, there's been a drop off through the week of March 27th of 33%. So these are the applications that people are completing to get loans to buy a property. Well, what do you think has happened since then? It's fallen even further. By April 3rd, it's down 41%, and by the week of April 10th, it's down 42%. So a lot less people obviously applying for new loans to buy houses. Well, that should make sense to everybody. The market tightens up. People are worried about how long is this going to last? When are we going to get the economy started here? Well, already the loans that were being written under the so-called non-qualifying loans. Now again, non-qualifying loans means they're not up to Fannie Mae, Freddie Mac standards, but non-banks don't have to worry about that. They're not as regulated as regular banks are. So let's take a look at this. Borrowers with lower credit scores, those are all gone. They're not writing those loans anymore, and probably not likely to do really for the rest of the year, depending upon how long this pandemic lasts. Mortgages with higher loan to value ratios also out the door. They want to see more down payments today, which makes sense. All the lenders are running for security, and the more money somebody puts down, obviously the less risk that a lender takes on. The higher their credit score, the less risk a lender takes on. Jumbo mortgages. Okay, so people who are getting more expensive homes, loan balances with over $500,000 in most markets, but in some of the more expensive markets out in California and New York and such, loans over $765,000, very, very difficult to get those loans today. Banks don't want to take on that much risk. And adjustable rate mortgages. Fannie Mae, Freddie Mac announced they're not going to buy those loans anymore because, once again, if we go back to 2006, 7, 8, when the loans were being written, with these adjustable rates, nothing down, pick-up payment loans, you name it, stated income loans, these were amongst the first ones to crash. And of course, that also goes back to this, non-qualified mortgages. These are mortgages that don't pass all the ratios which would enable Fannie Mae and Freddie Mac to buy these. Now, non-banks are the ones who are writing those type of loans. But where do you think non-banks get their credit lines? From banks. So this is not an isolated problem where a few non-banks lenders are going to go out of business. They are backed by banks, period. That's where they get their lines of credit. They use very little of their own money within that. So let's take a look at the Mortgage Credit Availability Index. And what this chart shows is how loose are the lending terms? How easy is it for people to borrow money? So if you go down here around 2012, there was a tightening of the market, right? It was very difficult to get loans. Well, that was because of the whole crash that we had just gone through. After that period of time, to get the economy going, to get people buying again and everything else, we're constantly on this little seesaw here. They started loosening up the credit, the down payments, all these other things, and that makes this Mortgage Credit Availability Index go up. It's easier for people to get loans, right? It's right there. There's more credit available to people. Well, you can see that there now has been a 20% drop on that. Why? Because things we just spoke about. They're not doing those type of creative, non-qualified types of loans. They've tightened it up once again. So 20% drop in the availability index, which means real estate sales are going to slow down considerably. In fact, I've got other videos coming up on that very same topic there. So expect a tightening in the real estate market. It's going to be much more difficult to move property because it's tougher to get a loan. That's what you're going to be dealing with as a real estate investor and as a note investor. Now, the good news, or part of the good news I can say in all of this, is this. This chart, if we extend it back out, and this is a great chart that they put together here for you to put things a little bit in perspective here. This 20% drop down to 152 on the index level, if we were to go all the way back to 2004, you can see that the credit availability, even as it is today, taking that 20% drop, is nowhere near what we had back in the lead up of the last crash. Imagine how easy, or this really illustrates, you don't have to imagine, you probably lived through this, right? It was so easy to get a loan. 2004, 5, 6, especially 2005 and 6, so easy to get a loan, and that's what this availability shows. And of course, after the signs were on the writing was on the wall that we're going to have a crash, they tightened that up immediately, and you can see we've been hovering down there around that baseline for a while with a little up and down, started to increase that, started to loosen the market again, and now drop of 20% here. But again, nothing like it was before. Doesn't mean that the crash won't be as bad. Again, a lot of this depends upon how long is the economy going to basically be shut down. But if it's not shut down a long time, we can recover from this. We're in better condition, at least from a credit availability index, as far as people getting a lot of these bad loans. We're in better shape than we were before. This has been Kevin Shortell. I hope you enjoyed that. We'll see you in part 5.